All right, folks, so we're going to pick up at part 2 of the question, which asks, show how the liability for the bonds payable would be presented on the statement of financial position as at December 31st, 2017. So when we go back to the question is asking, how is the liability presented on the balance sheet on December 31st, 2017. So the first thing we want to do is we want to figure out the time that has passed between when the bond was issued and the date that they're asking us. So December 31st, 2017. If we look back to our summary, we know June 30th was when the bond was issued. So June 30th, 2017. And now is December 31st, 2017. So if we rounded that, we'd know that that's about a half a year. So July, August, September, October, November, December, 6 months, so we know that's half a year. Now that's going to be important. So rather than going directly into the balance sheet, we're going to work our way through what the journal entries might be, or how to calculate the different pieces, and then we'll go into creating the balance sheet. So first things first, what we know from the journal entries is once you've initially set up the bond, the first thing you want to do is have interest payments. So we'll go ahead and we know that there's going to be a debit for interest expense, and we know that there's going to be a credit for cash, which is the interest that's going to be paid. Now what we do know is when we set up the bond, there was a premium. So to bring this premium down, since it's a credit, we need to debit the premium, and we're going to say premium amortization. All right. So when we work through this, the first number that we know, and that's the easiest to calculate, would be the interest expense, or the cash that would be going out. Now the one catch with this question is if you go back to the fact pattern, it says interest is paid annually on June 30th. So when we've gone from June to December in the first 6 months, there is no interest that's actually being paid. So a mistake I'm making here is I'm trying to credit cash when in fact I should be crediting interest payable. All right, so let's go ahead and fix that. So to calculate the interest payable, we know that interest on a bond is paid on the interest rate that's stated on the bond. It's not paid on the market rate. So 6.5% is the annual interest rate, and the face amount is $4 million. So since we know that this is for half a year, we're going to say $4 million times the interest rate of 0.065, which is 6.5%, which is the stated amount, times half a year. All right, standard formula for calculating interest, and we know that amount is $130,000. I'm just going to put negative because that's a credit, so that's the cash going out of the business. Now we know this company is using the effective interest rate method. So what do you do when you've got the effective interest rate method? You take the total value of the bond. So we're gonna use our exact amount that we've got from our proof. All right, so 4229376, and whether you use the $2 off or not, it doesn't really matter. So you take the initial value of the bond, the total value, and then you multiply that by your stated rate, all right, which is 6.5% times half. All right, and what you get here is 137 for I stand corrected, not the stated rate, the market rate, because the stated rate is what we use for the actual interest. The market rate is what we're using to calculate the expense. So what you should get is 126,881, and we're not so fussed with the decimal places, so we'll make that go away. And now you know that when you're amortizing your premium, this entry needs to balance. So all you've got to do is calculate the difference and put that in as the difference. So what we're going to do is minus this, minus that, and the difference should show up as a debit of 3119. And just to make sure that our entry balances, and we didn't make a mistake here for the pluses and minuses, $0 there. So 3119 is our amortized premium. Our interest expense is 126,881, and we know the cash interest that we would have had to pay would be 130,000. And the reason it's not cash and it's payable is because interest is paid annually in this case. So now we need to go ahead and figure out what this would look like on the actual balance sheet. So we use the appropriate formatting, Shref Limited for the header. We want to say statement of financial position, and which is the equivalent of a balance sheet. And we say as at December 31st, 2017. And it's important to get this kind of formatting right because there may be a mark or two associated with making sure that your formatting is appropriate. So try and get these headers down as best as you can. As at is your year-end date. So what we're going to have is one category will be current liabilities. Right? And in current liabilities, we know interest payable is a current liability, just like accounts payable. So we write interest payable, and that's 130,000. And that's the only current liability that we have. And then we know the bond itself is a non-current liability. So if you're a non-current liability, your long-term liability, doesn't matter. Both are okay. So you write the bond payable. And here you would start with the face value of the bond, which you know to be $4 million. And you've got your premium. And first let's take the original premium that we calculated. And that was 229,374. So 229,374. And this is, so you take the total, you put that in there. There we go. Then you go less premium amortization. And this is what we just calculated here, 3119. And you take the difference between the two, which is 422,6255. So this would be your bond payable, which is what you are recording on your balance sheet. So the solution will show this amount here, and it'll show the difference between this 229,374 and the amortized portion of the bond premium, right? Which is the summarized version. We've sort of shown all of the math here, and there you go. That's how you'd record that amount on the balance sheet. So we'll stop the video here and go on to the next video, which is going to be calculating the interest when it is actually paid.